Hold on tight. This is a critical emergency alert for every XRP, stock, ETF bond, and gold holder watching right now. What we're seeing isn't exaggeration. It's a financial shock event rippling across global liquidity rails. Yesterday, XRP plunged to $1.50 in minutes, then snapped back above $2 as if someone flipped a switch. That wasn't random. It was coordinated liquidity movement triggered by ETF desk rotations and bond market rebalancing. And if you own stocks, gold, or crypto of any kind, this directly affects you. Strap in. I'm serious, because over the next 60 seconds, you'll see why this wasn't a crash. It was a stress test for the future of money. If you click away now, you'll miss what could be the single most important breakdown about market updates anywhere online. Quick note, before we dive in, make sure you like and subscribe right now so you don't miss the next critical drop that contains highly valuable information. Additionally, it really helps push this message to the masses, and every subscriber here is part of the awakening movement before the system flips. At the time of recording, XRP is trading around $2.49. If you're watching later, that number may have shifted. This is not financial advice. Always do your own research and consult a qualified professional before making any financial decisions. So what really happened? Behind closed doors, Ripple and its partners are testing something called real-time liquidity synchronization. That means ETFs, bonds, and tokenized gold are starting to communicate across blockchains and legacy systems. When a large fund rebalances its holdings, say reducing bond exposure and boosting gold allocations, that capital doesn't sit idle anymore. It passes through digital liquidity rails to settle instantly, and XRP is one of those rails. The moment those orders hit, algorithms react. Liquidity is sucked from one corridor and injected into another, and price volatility explodes for a few minutes. Then, just as fast, balance returns, because the system absorbs the shock. That's why the $1.50 flash crash and $2 rebound were not retail panic. They were the sound of institutional pipes connecting. The same mechanism happens in traditional markets every quarter when funds rebalance, but this time it happened on-chain, visible to anyone watching the ledger. Think about it. Gold is hovering near record highs. Treasury yields are flattening as investors rotate into safety. And now we're seeing those same flows bleeding into the digital realm through XRP. It's the first time legacy and crypto markets have moved in unison. The bridge between the old world and the new is no longer theoretical. It just got stress tested in real time. Every major correction in history has a moment like this, when investors realize that what looked like random volatility was actually infrastructure coming online. Bitcoin had it in 2013 when exchanges started talking to banks. Gold had it when ETFs like GLD turned metal into tradable liquidity. And now XRP is having its moment as the settlement rail for tokenized value. The difference is speed. What used to take weeks now happens in seconds. Older investors understand this better than anyone. You've seen liquidity cycles before, like the '87 crash, the dot-com bubble, the credit crisis. This is the same thing, but compressed into a digital heartbeat. That's why the market feels so violent now. The pipes are instant, the capital is global, and the algorithms don't sleep. Hang in there. This isn't the end. It's the calibration. Whales aren't running. They're repositioning for a world where settlement happens in milliseconds. Every dip is a test of the new plumbing. And if you can see it for what it is, you stop reacting emotionally and start thinking strategically. Here's the takeaway for the next 60 seconds. We're not in a collapse phase. We're in a liquidity realignment phase. Traditional funds are moving capital through tokenized rails for the first time, and XRP is the bridge they're using to do it. Every whale that moved yesterday wasn't exiting. They were testing corridors. So what's next? Expect more volatility, and that is why you really have to be in tune with the entire message of this video. Most people will skip and miss the most crucial details. Because of sheer impatience, don't be one of those people. In reality, you can expect headlines that confuse emotion with data, but understand that each spike and each rebound are revealing who actually controls liquidity. When the next shock hits, the difference between fear and understanding could define your portfolio's future. If your portfolio includes stocks, bonds, or XRP, what I'm about to show you could determine how much of it you still own when the next liquidity event hits. When markets swing like this, people always ask the same thing: how can it move that fast? The answer isn't emotion, it's liquidity corridors. Think of each ETF, gold fund, or bond desk as a tributary feeding into a river of capital. When one side adjusts, say a bond ETF reduces exposure to long-duration treasuries because yields tick up, billions in liquidity get freed. In the old world, that money would take days to redeploy. In this new world, it moves in seconds through tokenized rails. XRP is one of those rails. It's the bridge between fund liquidity and real-time settlement. That's exactly what caused yesterday's flash swing. Treasury and gold ETFs rebalanced, freeing idle liquidity. Algorithms then searched for yield and throughput, and they found XRP. Those micro-rotations created a vacuum. Bids vanished, price dropped, and within minutes, new capital filled the gap, snapping it back above $2. That's not chaos, that's infrastructure finding equilibrium at machine speed. And here's something few talk about. Every ETF rebalance now involves digital liquidity mapping. When custodians run overnight reconciliation, they factor in tokenized assets and blockchain-based settlement. The rebalancing software literally pings liquidity networks like RippleNet to calculate optimal settlement routes. That's the quiet integration no one sees, and it's happening while the mainstream still calls crypto speculation. Now give me 5 seconds for a quick note, because people keep asking where I actually track this in real time. Honestly, I use MEXC. It's where I can see liquidity rotations the moment they occur. The depth charts light up before anywhere else, showing which corridors are being tested. I'm not sponsored. It's simply the most transparent data feed I've found. If you want to watch it the way I do, the link's in my description. No pressure, no pitch. Just the tool I use daily to spot when institutions move. Back to the flow mechanics. When these rotations hit, you'll often see Bitcoin or Ethereum lag while XRP reacts first. That's because XRP's ledger is settlement-oriented, not speculation-oriented. It absorbs pressure, clears it, and normalizes faster. In traditional markets, that would be like the plumbing inside Swift, absorbing multi-billion-dollar FX swaps in milliseconds. Except now, it's all transparent. You can literally watch the heartbeat of global liquidity on-chain. The big takeaway: whales aren't manipulating, they're synchronizing. This is what market maturity looks like. When gold, bonds, and digital assets start moving in tandem, that's not correlation, that's convergence. If you have made it this far, strap in for another 30 seconds because you're not going to want to miss this next key detail. You can't out-trade institutional algorithms, but you can out-understand them. Once you grasp the plumbing, volatility stops being a threat and becomes confirmation that the system is alive. If you're enjoying this content, make sure to like and subscribe. It really helps get this message to the masses, and it's greatly appreciated. Zoom out for a moment. When you connect the dots between what just happened and what's unfolding across global markets, it's crystal clear. This wasn't a crash, it was a signal. Interest rates have peaked. The Federal Reserve, the European Central Bank, and the Bank of Japan are all preparing for policy shifts that favor liquidity expansion. When that happens, capital leaves safety and looks for velocity. Historically, that meant equities and commodities. But this time, something new exists. On-chain settlement rails like XRP that can move capital faster than any asset in the history of finance. That's why yesterday's $1.50 to $2 rebound wasn't noise. It was the test run for a market structure that will eventually operate 24/7 across bonds, ETFs, gold, and digital ledgers. Think of it like the early days of SWIFT, when banks first realized they could move money electronically instead of waiting for couriers. Back then, the world didn't understand what they were seeing. Now we're watching that same moment repeat, except this time it's instantaneous and global. For the older investors watching, you've lived through these transitions before. You saw how ETFs changed stock ownership forever. You watched gold shift from a static store of value to a dynamic trading vehicle. What's happening now with XRP is that same evolution, but at machine speed. The infrastructure is going live in real time, and most people won't realize it until after it's fully operational. Every major fund rotation is now tied to liquidity efficiency. The moment gold ETFs rebalance, tokenized bond flows shift. When yields compress, capital migrates toward assets that move fastest, not those that promise the most hype. That's why XRP keeps showing up in the same sentences as gold, bonds, and ETFs. It's not coincidence, it's liquidity logic. Here's the truth that no one on mainstream media will tell you. XRP is no longer a speculative bet. It's an infrastructure position. Its volatility is the side effect of being plugged into everything. The same way volatility hit equities in the 80s when derivatives went mainstream. This isn't a retail market anymore. It's a liquidity network absorbing institutional weight. The emotional investors, the ones refreshing charts and panicking on every tick, are playing checkers. The disciplined ones are studying balance sheets, regulation, and settlement architecture, because that's where the real game is being played. Remember this: markets are forward-looking. Prices react before the headlines catch up. So when you see XRP mirroring gold's movement or echoing ETF inflows, it's because the system is already syncing. The settlement rails are connecting beneath your feet, and every moment of volatility is the price of admission into that transformation. For long-term holders, this is where conviction meets validation. If you can see beyond the noise, you understand that the crash was just the system testing its capacity, and it passed. The liquidity returned, price stabilized, and participation grew. That's not weakness. That's proof. So here's the bottom line. Strap in. Because the next time XRP moves like this, it won't be a warning. It'll be confirmation that the global liquidity network is live. The bridge between traditional and digital finance is complete, and value can finally move across borders without friction. When that happens, the world won't ask if XRP is real. They'll ask who saw it coming, and the answer is you. So if you believe in truth over noise, if you see where the world is heading before the crowd wakes up, make sure you like and subscribe right now to never miss crucial information. Every subscriber here isn't just part of an audience. You're part of the awakening of the Matrix movement. See you on the next one, my friends.